Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In today's video, we're going to talk about investing in a slowing economy. As an investor, if you've been tracking the news, you've probably come across this item on India's GDP growth. So the Q2 numbers came out and they were quite a disappointment for a lot of investors. The narrative around India's growth trajectory has been that we're doing very well, we'll be growing at 6.5 to 7%. Yet, when the GDP numbers actually came out, they came out much lower than what was expected at 5.4%. So, clearly there's been a big mismatch between what markets and investors are expecting versus the ground reality of how the economy is actually growing. So there is a slowdown that we're seeing. Whether this is a temporary blip or something that's going to be more prolonged is something that we still have to watch out for. We don't know the answer to that question yet. So how did the markets actually react to this piece of news? If we look at how the markets responded, it doesn't seem like they've really fully processed what's going on. At one level, you see the index continuing to rise. You're not actually seeing investor sentiment really change. But if we look at what FIIs are doing, they have been continuously trimming their positions down. November was a month of heavy selling with net FII outflows amounting to almost 46,000 crores. Right? So you're still seeing very strong domestic participation in the markets, which is what is keeping them at a flat level. So if we look at how the Nifty moved in November, you had a steep decline that occurred for almost 3 weeks continuously and relentless FII selling through this period. And then the last 1 week you saw a reversal, and then that is what led to the month's returns being almost flat at the Nifty level. But coming back to our ground realities, we have already seen a fairly disappointing earnings season from corporate India, and investors haven't fully factored that into their expectations and valuations. When the economy slows more, investor disappointment can only increase. There is no room for disappointment in any of the valuations. So this would mean that an investor needs to be a lot more conscious and cautious of how they are planning their investments. If you are looking to manage risks better today, there are 3 important things that you can do. The first is use this rally to your advantage. Right? The market is rallying in a context where there is a need to be more cautious, which means that one can actually use this rally to trim down positions, exit weaker companies or funds, and then restructure their portfolio. The second important thing that you can do is brainstorm. At this point, if you can think of themes and ideas or investments that can actually do well in a slowing economy or in a low growth environment, you might be prepared to deal with the challenges that come ahead of you. The third important thing that you can do is to adjust your asset allocation, because asset allocation can give you more flexibility and adaptability as the market context also changes. Remember, there's an important saying in the markets, which is that the markets can remain irrational longer than you can remain solvent. So why should we play this guessing game of where the market is going and what it's going to do? Instead, we can focus on managing risks in our portfolio better. If you enjoyed this video, you should know that we publish 2 videos like this every week, and you can be the first to watch them if you subscribe to our channel.